morning. Yes, as Adam said, I've been asked to speak about early stage investment. Before I do, I just thought I'd give you a bit of background on Turquoise. As a business, we've been around for about 10 years. Really, our main business is an investment banking business, raising money, debt and equity for projects and for technology companies, and also buying and selling companies. But lastly, we've also got into the investment business, focusing really on the early stage. And we have various pots of money that we invest out of. The first we set up Turquoise Capital in about 2005. That's really very early stage money where we get involved with founding a company with some management team. But then in 2010 we were appointed as fund managers to the Low Carbon Innovation Fund, which I'll talk about a bit more later. We focus on energy and environment, and this slide is really intended to show that we have been very active in quite a lot of the different subsectors of clean tech and renewable energy. This isn't all the deals we're involved with, but it's, I think, a good set. Most of these are out of our investment banking business, so they're not necessarily early stage businesses. But some of them here are certainly pre-revenue companies, so certainly early stage from the perspective of an investor. So the Low Carbon Innovation Fund is a £12.5 million early stage fund. The money comes from the European Union Regional Development Fund, and that was allocated to the East of England Development Agency as was, and then from there went to the University of East Anglia, and we were asked by the University of East Anglia to manage the investment of that money. And it's focusing on early stage businesses with a low carbon focus in the East of England region, and that's basically East Anglia. And we invest between £500,000 and £50,000 per deal, so quite small. And over the fund in total, our investment needs to be no more than 40% of the total amount of money in the deals that we invest in. On a one-off basis, we can invest up to half, 50% of the investment in a single round, but over the portfolio it needs to be no more than 40%. And that means we have to find co-investors for all the deals we work on. In this environment, it's not very easy to do that. Lord Drayson mentioned it was very hard to raise money in July or June, mid-2009. I think it might be harder now than then. Possibly because then there were venture capital funds who had money to invest. Now many of those have invested their money, or what money they have left is dedicated to the portfolio. So most of the money that we co-invest with is, or a lot of it is from high net worth individuals who are investing through EIS. We're fairly flexible about the type of investment we put in, so we can structure it as mezzanine, convertible loan, or any other structure really, but it's all looking for an equity type return. And we've made 10 investments to date, and we've had our first exit, which is good. Very often these businesses take 5 years or more to exit, and we were able to exit one of ours, or a partial exit, after 9 months. But that was, I think, more luck on our part than foresight. So what we look for, this I think is probably what most investors look for. The main thing is, the first thing is an experienced management team. I think especially at the early stage, if you don't have an established business with revenues and profitability, the main thing you've got is the management team. So it's really important that they are impressive people who know what they're doing and will be able to create a business. Ideally also, there is a business that can scale. As an investor, we're going to need to sell our investment or exit at some stage, and it's a lot easier to sell a £20 million business or a £50 million business than a £2 million business. And also for us to get a return, we need a big business. As a small fund, we look for low capital intensity companies. So if a company comes to us and says, well, we need to raise £20 million or £50 million before we reach break even. And an example of that could be a wave or tidal company looking to develop technology. Then it's very hard for us to invest in one of those businesses because really we run out of money very fast, and the money we put into the business isn't going to take it to profitability. So whereas we sometimes do take the punt and assume that there will be more money available from other investors, usually we try to ensure that the investors that we go in with have enough money between us to get them business so that it is cash flow positive. IP protection, if we're investing in a technology company, clearly there needs to be protection. It's very silly investing if we go into a company and then as soon as they prove the concept, 5 other people come and steal the market. So in addition to management team, technology and IP are the key things we look at. Also at an early stage, the technology we look at has to be market leading. If there are established businesses in a sector and the technology we're looking at is maybe 5% better, then it's very unlikely that technology will ever be adopted by the industry, because the hassles of dealing with an early stage business which isn't creditworthy, which doesn't have a reputation, just isn't going to work if cost savings are minimal. So we're really looking at game-changing technology where either a piece of technology exists where there is no competition, or if there is competition, it's a hugely better, cheaper piece of kit than the existing technology in the market. In addition to technology, we also look at projects. We don't fund project construction. I think other people today will talk a bit about that, but we do look at project development. So this is the stage where a company is looking to build a project, but before they build it, they need to get planning permission, they need to find a site, they need to get licenses, they need to get off-take contracts, feedstock contracts, and that process can take several years. It can cost hundreds of thousands of pounds, even millions of pounds for some technologies, and that is particularly hard money to raise at the moment. So we do look at good management teams looking to develop projects. This is an example of a deal that we've worked on, and it's, I think, nicely linked with the earlier session about EVs. This isn't an EV company, but it's a company that's focusing on electrification of the vehicle and vehicle efficiency. It's a business that Turquoise Capital helped found in 2007. I mentioned earlier that it's hard, that we need to make sure our technology we invest in is market leading. And as people with a finance background, it's very hard for us to assess the technology market and decide whether or not one technology is better than another. So quite early on, we helped found a business called Turquoise International Consulting, which is staffed with people who are technology specialists. And one of those identified in 2007 the team that was sitting in Vistian, which was formerly Ford's part business. It was part of Ford, and they spun it out in about the year 2000. And they had been developing leapfrog technologies to make internal combustion engine cars more efficient. And by 2007, they were walking into a Chapter 11 situation. They had no more money to spend on the technology. And through our technology consultant, we were aware of the technology and aware that nothing was happening with it. So we approached them initially to see if we could help them spin it out and raise money for it. They weren't interested in that because it was they were worried about hundreds of millions of pounds item rather than small numbers of £1 million items. So this just wasn't on their radar. So we then negotiated to acquire the business. So at the end of 2007, we raised some money, both from ourselves and also from third-party investors, and we set up Control Power Technologies. And we brought alongside us a lot of several investors who would at the time look at early stage technology. Some of those no longer do. Conduit Ventures being one, quite well-known VC in the sector, Entrepreneurs Fund being another. We also had some slightly unusual people, Kuwait Petroleum, Entech, which is another Kuwaiti business, Target Ventures, which is an Irish family office, and several others. And basically what these technologies do is they use switch reluctance motors in vehicles to reduce fuel consumption. And this first little unit there is an electric supercharger. And if you have a vehicle which has, let's say, a small engine, a 1.2 litre engine, you can put a turbocharger on it and get a lot of power out of it at high engine speeds. But at low engine speeds, when you're starting from the lights, it will be very sluggish, especially in a heavy vehicle. But if you can put an electric supercharger on it, then you effectively have turbo boost from startup within 250 milliseconds of putting your foot on the accelerator. And that means with no turbo lag, you can make a heavy car drivable. So I say that it's about a 1.2 litre engine could be equivalent in power throughout the rev range to a 2 litre engine. And we sold this particular product to Valeo, which is a French tier 1 OEM, or tier 1 manufacturing business selling to car companies, and that was sold for 30 million at the end of last year. And when we sold it, we had no contracts with car companies. Car companies were trying it, but no one had said we want to buy it. But since then, Audi have announced that they are looking to use this product. Although they haven't mentioned the product by name, but it certainly is the same product. So while we don't own it, it's very satisfying to see that something that we've developed is now coming to market. In addition to that first product that was sold, we are developing 3 other products, also all based on the same core technology, which is switch reluctance motors, that technology was originally developed in the UK. But since then, the technology was first bought by Emerson, a big US electric motor business, and then since then by Nidec, which is a large Japanese electric motor manufacturer. The 3 products here shown, the first one on the left is Speed Start, which is an integrated starter generator. If you have a new car, it probably has start-stop on it. So when you come to the lights, the engine will stop, and when you want to go again, you take your foot off the brake, or you put your car into gear and the engine will start automatically. This is a next generation from that. As well as starting and stopping, it will charge the battery very efficiently. It will also produce torque enhancements, so at low speeds, a bit like the supercharger, it will give added boost to the crankshaft. And it also has a few other tricks that it does. It's a very robust machine, so it will last for what we've tested to 1.2 million start-stop events, cranks, and that's about 4 or 5 times more than a normal starter generator. And that kind of robustness is required for some hybrid drive cycles where the engine will be turning on and off many times during a journey. So for instance, if you're driving down a hill, the engine the car will say, we don't need the internal combustion engine, it will turn it off, and as you're coming up the hill, it will turn it back on again. And so you need a very robust, very quiet, very quick starter for that. The second product is a turbo generator, which captures exhaust, energy loss from exhaust. About a third of the energy from petrol or diesel is lost through the exhaust, and looks to capture some of that with the turbine and the exhaust stream. And then the third one is another supercharger, but this time for larger vehicles, above 3.5 tons. And just to say, we're currently doing fundraising for this company, raising 5 million, of which about 2.5 million is coming from existing investors. Another company we've invested in through LCIF. This is a spin-out from Cambridge University. It is a business that manufactures natural ventilation systems for buildings. The systems are best in class, highly efficient, and effectively what they do is they mix hot air in the building with cold air outside, so that one of the issues with natural ventilation is often it results in drafts. If you have cold drafts, you need to then have heating to heat the incoming cold air, which then means it costs a lot to run heating. This is a way of mixing the cold air coming in with hot air going out, so that there are no cold drafts, so that most buildings, most schools, offices that have a lot of people inside the rooms and therefore create a lot of energy from computers and people, they don't need a lot of third-party heating if the building is managed well. We led that round £1 million with MMC Ventures, who were an existing investor, and 30 investments also coming in. Freedom Builders has about £2 million of revenue, so it's not a pre-revenue business, but it is pre-profit. And many of the VCs now are looking for businesses that are positive at an EBITDA level, so they have positive operating profits. And this business is probably a year or so away from that. I think this will be covered probably by some of the other people, but just to say, it's very, very difficult in the market at the moment raising money for early stage businesses. There are very few investors, very few professional investors in this market. Partly because it's difficult to make money, because the track record of some of the early stage funds hasn't been good, and partly because there are good opportunities at later stages, and since later stages is lower risk, people tend to move towards lower risk. But I think I'll let the other people who are speaking later cover that in more depth.
Very interested in what you said, and following on from Lord Drayson's talk, you've actually hit the nail on the head, which is there is no funding really out there for early start businesses. And I'm just wondering, is there now a role for government to play, and if so, what? Because actually, most of the VCs out there, as you said, they want all companies who've got income and have got lots of EBITDA. That to me is not about venturing, actually. That's about lowering the risk of your investment in an early start company. Where's the venturing in that? So I throw it now because I have to leave on the spot at 12:30. But maybe you'd like to give an answer, one or both of you.
Well, I think there is a role, because traditional LPs, who are the people who would fund venture capital funds, I think are shying away from early stage, mainly because the track record, when you look at the different funds who have invested in the sector in the early stage, later stage funds tend to do better. And so if you are a pension fund or a family office, or you are someone who deploys money to funds, very often you're going to look at the returns of the various funds and you're going to go after ones who have the best track record. So that's a simple reason. And I think there is more money now from high net worth individuals. I think that the changes made to EIS rules has been very helpful. But I think certainly our fund comes from the European Union, so it is government money. And yeah, I think the Green Investment Bank is doing good things, and hopefully they will do more of the same, and maybe they'll look at some funds that do focus explicitly on early stage.
Do you want to add something? Yes. I think the answer very quickly is yes, absolutely. And what VC investing tells us, looking back, particularly going through the peaks and troughs of VC investing over the last 25 years, you've got to have two things. You've got to have a long enough time horizon in your fund, and you've got to have a big enough fund. Our funds over here in Europe have been too small and have been too short. Now, what government can do is create an environment whereby you get consolidation to create billion-pound funds which are long enough to make sure that you have a few absolutely standout successes which provides a return. That's how they do it on Sand Hill Road. That's how they do it here.